right. Well, hi, everyone. Thank you very much for joining us today. We are very excited to welcome Brian Borzakowski, who is an award-winning business journalist who writes a regular investing column for MoneySense. He's also written for many other leading publications and is the founder and editorial director of All Caps Content, an agency that creates editorial-style content for businesses and healthcare organizations. He spent the last year as president of the Society for Advancing Business Editing and Writing. We're also excited to welcome Sandra Martin, who has 20 plus years of experience as a journalist, is an instructor at Ryerson University's School of Journalism, and is editor-in-chief of MoneySense. Under her leadership, in January of 2020, MoneySense picked up a Silver Canadian Online Publishing Award in the Best Service Article or Series Consumer category. Ms. Martin's byline has appeared in the Globe and Mail, Cottage Life, and the National Post, among others. Brian and Sandra, thanks for joining us.
It's great to be here. Thanks for having me.
Thanks for having me.
We're going to have probably Brian and I talk a lot. And then just forewarning, because of Zoom, we'll probably talk over each other, and because we're Canadian, we'll apologize. So just be prepared for some of those. So I just want to kick it off by saying, I mean, Brian, you've been in the business so long. I mean, you're young, you're a millennial. Kind of feels like you came out of the womb writing about investing. So really excited to hear, sort of your take on some of the top issues, some of the things you cover in your column for MoneySense. But probably what's on a lot of people's minds right now, especially if you were watching the presidential debate last night, is what could the outcome of the US election mean for Canadian investors?
Well, I wish there was an easy way to answer that, but after last night, I don't think anyone has any clue as to what's going to happen and what the outcome could be for anyone. It was, quite the debate. And without trying to get too political, it did make me a bit nervous being a Canadian north of the US border. And I think the bottom line there is that what we've seen is that what happens in the US, we've known this for a long time, but I think over the last few years, it's been, reiterated again, is what happens in the US happens in Canada. I mean, our market goes where the US market goes most of the time. We're not maybe quite as, we'll probably talk about this, but over the last year to date, I mean, we're not up, we're lower. We've lost, our return is lower than the US, but generally it still follows. So what's good for the US is generally good for Canada. I mean, Trump has been very interesting over the last few years for the Canadian market. Generally, stocks have done well, I think, to the surprise of many, given just sort of the uncertainty and some of the stuff that he's talked about. And so that has helped the Canadian market a little bit, kind of follow the US. But I think there's also been issues around NAFTA. There's aluminum tariffs that were sort of put on arbitrarily recently, and then a couple of years ago. That stuff's never great for the Canadian market. Our energy sector could benefit, even though it's been kind of down in the dumps for the last little while. But Trump is a bit more pro-energy than the Democrats are, but at the same time, Joe Biden administration could bring more certainty to the world, which would help calm people's nerves and maybe get people investing again. And especially with the pandemic, I think there's a lot of nervousness around border closures, doing trade with the U.S. A lot of people, I haven't traveled to the U.S. Since January. I do go, fairly frequently for work and stuff like that. So, just as a small business owner, it's maybe impacted my work, and you can see how that could be on a, extrapolate that out to a much larger scale. So I think if they can get the pandemic under control, then that could be good for Canada in the long run. But, everything is a bit, there's two sides to everything. Trump does want to keep the economy open, and that could be also beneficial to Canada if Biden comes in and kind of shuts it down. So the answer is I have no idea, but there are, I guess, different benefits on both. I just think that if the US is healthy, Canada will be healthy. And that's really, as an investor and a person who cares about the world, that's kind of what I want to see.
So you touched on the energy sector being so important for Canada. That segs into the first area that we wanted to cover here, which is what are the most important sectors in Canada, and kind of what should investors keep in mind, given that we're in a pandemic, given that energy use is dramatically down right now? What do you say?
Yeah, well, we're still a fairly concentrated market. We still have financials making up close to 30% of our market. Energy has come down over the years. I mean, it's not as big of a part. I'm just looking at S&P Capital IQ, which is the program that I use. Unfortunately, I can't afford a Bloomberg subscription on a business journalist salary, but that's about 11%, and materials is around 15%. That's, I think, increased a bit over the last little bit with gold prices doing so well. But the energy sector is in trouble, I think, for a while. The world is moving to renewables slowly. Still need oil and gas. That will be around for a long time. Our market has shrunk by a ton. I was talking to a fund manager recently who was saying that there were about 30 listed TSX companies recently, oil companies or energy companies. Now there's about 7. That's created some efficiencies in the market, but there's less investment opportunity there, and you're really sort of relying on a few companies, the big ones, but a few companies to drive the market. And so I think oil prices will probably stay low for a while. Demand is picked up a bit. If certainly people are going to work, but if there's another lockdown, that could really impact prices. But we're not back to the $100 barrel of oil price range for a long time, if ever. And I think the Canadian oil companies are getting more technology focused. So they're focused on creating more efficient ways to get oil out of the ground. And that could help with prices. You have that basically produces stuff at a low cost. But I think for investors, it's not the slam dunk opportunity it was, during the oil boom, where you can just buy any of these companies and do well. So could they be part of a portfolio? Maybe the right ones, but you can't just kind of buy the sector and hope it'll skyrocket again for years to come.
Let's talk about financials a bit, given that they do make up 28.6% of the index. Last quarter earnings a little bit mixed. A lot of the big banks doing well still. How can investors get a sense of whether the banks are sufficiently protected against default? We're all waiting for this shoe to drop. Particularly around mortgages, around loan default, and then looking at the bigger picture, corporate debt. What should investors look for if they're scoping? Like, should I still hold this financial institution in my portfolio?
Right. Well, I think generally Canadian banks are always been kind of prudent and with the money that they're spending and how they operate. And we got through the financial crisis in 2008 well, better than a lot of other countries. And Canadian banks were held up as a gold standard. It's a bit of a different environment now. I think the Canadian market wasn't as affected in 2008 by the recession. We didn't have subprime loans. Our banks weren't holding those mortgages in the same way that U.S. banks were. We had some other issues here, but we got through that pretty quickly. And now we have, an indebted consumer. We have a real estate market that's hot, still hot, and risks of defaults. And if people can't, as you said, afford to make payments in their business, those could go belly up too. I think the banks generally, their prices have come down because there is concern around this. They've set aside billions of dollars in kind of loan loss provisions, so they're protecting themselves. That does hurt the profit that they can make kind of going forward. So I don't think you'll see earnings as high right now. And we've also seen interest rates come down by a ton. Now that always affects banks because they make a lot more money when interest is higher and they can make money off rates. So I think they will struggle for a bit. Their price to earnings ratio is certainly lower than it was kind of before the pandemic happened. So there could be an opportunity there. They're still paying their dividends. We haven't seen dividend cuts. I think it could be a bit of a rough ride, but basically, I still think if you want to see if they're good, you stick with the big banks. You see how much they put aside to protect for defaults, and are they well protected there? And how are they managing their money? What are they investing in today? And I think it's the same basic things you look for in any company. But I still think for the average investor, holding financials is still a wise decision. They're still stable companies. They're still paying that dividend. And it's hard to imagine a scenario where a bank, TD Bank, BMO, any of these banks go under because of too many defaults. Could be some short-term pain, but if you're a long-term investor, I still think those are probably some of your best bets in the Canadian market.
What's your sense of whether people are holding cash? I mean, it seems like kind of a wasted opportunity right now. But at the beginning of COVID, a lot of people were sitting in cash. Some people had even sold off investments to their sadness in short order when they realized that was not the right thing to do. Are people sitting in cash now? And for those who are, what would you say they should consider?
Right. Well, I mean, I don't have any exact numbers to know how many Canadians are sitting in cash, but just on sort of the general psyche of people, I think there's still a lot of nervousness in the market, especially as we see cases rise. The market hasn't been doing as well as it was from March 23rd when it kind of bottomed up to June. There was a big gain there. It's still gone up a bit, but there's been a lot more volatility. It's been a bit flatter, so we haven't kind of seen that V-shaped gain like we saw after sort of people kind of calmed down in March and things just kind of took off. But to me, I mean, it's easy to hold cash if you're sort of the average investor. I would say leave cash to the portfolio managers and let them decide what to do. Even though, and part of me thinks, I've talked to lots of portfolio managers in the past who have held, 60% in cash, waiting for a big market drop. I think they're investing again, but to me, holding cash, it doesn't really do anything. I mean, inflation is low, so you maybe can make a little bit of a return. If you put in a high interest savings account, you could actually maybe make a return higher than inflation at the moment. But over time, stocks go up and we'll see ups and downs. But if you've got a longer time horizon, I think you got to stay in stocks. I haven't, pulled my money out. There's no point in timing the market. I don't know when things will crash again, and then after that, when things will go up. So I think a lot of people probably are still holding cash because they're nervous, but they could be missing out on opportunities just over the long term, just because you never know how the market's going to go.
Let's talk about the real estate market. So, I mean, there are a lot of Canadians who invest directly in real estate. They're landlords, or they hold real estate through REITs. I personally have been waiting for the market to drop for many years now. I know we were chatting about this last week, Brian. I've held real estate since I was 25. So do the math, for the last 24 years. And that bubble there was like a slight burst just before I became a real estate owner. And it's pretty much just gone up since then. Yet we're looking at historically low interest rates. I've talked to a few sort of professional real estate investors for MoneySense, and they've all said they think this is prime opportunity time. They're not really hesitating, but they have much more capital to deal with. So for people like us, what are some things that you think we should check out?
The real estate market in Canada. I mean, it's that's as hard to predict as the American election as to where that will go. But the MoneySense and Maclean's and Canadian Business have been predicting crashes for years. I remember I'm working for myself now. When I worked at MoneySense, a decade ago, there was covers where the crash is going to happen, and it hasn't. And will it happen? I mean, everyone thinks that the Canadian market is overvalued, that it will happen, that there will be a crash. For me, it's hard to see it in that, first of all, rates are low, as you said. And when rates are low, it's a lot easier to buy a house. People may be in more debt than they have been in a long time. And actually, that isn't true. Debt levels have gone down a bit only because people are spending less from the pandemic, but generally it's higher. But your servicing costs are a lot lower. I mean, my mortgage rate has fallen. In 2011, I went to a variable rate mortgage, and it's been basically falling ever since. It went up a little bit when I renewed a few years ago, like a couple years ago, to 2.85. It's now at 1.35%. And so that's insane. And that does not encourage me to pay down my mortgage. I'd rather put that in investments and hopefully make a better return. And so I think that people will still buy. I think people will still be stretched. And the concern is when rates rise, what happens then? They will rise. I think they'll rise very slowly. And it could be, we've seen since 2011, I mean, rates have really not gone up that much at all. I mean, we were down pre-pandemic. The overnight rate of the Bank of Canada was 1.75%. I mean, that's low historically. And so I think they'll stay low. And so I think if you're looking to buy a house or an investment property, you could do that now. There's no point in waiting for a crash because it may or may not come. And real estate to me, especially for a primary home, it's a place to live. I mean, you really have to kind of separate the investment opportunity there. Hopefully when you retire, it'll be worth more, but that you shouldn't put all your money in real estate and then not in the stock market or in other investments, because you don't know what's going to happen. But you have a place to live, you're making a home with your family. That should be the first priority. And for a second house, I mean, rates are low. You could get that. I think in Vancouver and Toronto, price appreciation will certainly continue. People still want to live there, despite the high costs. Rents have been falling in some areas in Toronto. And so there might be more, supply in the market right now, which could hurt yields for your rental income. But I do think over time, once the pandemic works itself out, and it could be a little while, that things will kind of return to some sort of normalcy. And just one last point is that we actually have seen prices rise in Toronto. I mean, sales have been lower, but prices are still rising. So it's not like you think right now we'd see a crash if there was to be one, but that has not materialized.
So I live in Toronto, and just because I am an interested watcher of the real estate market, I've been chatting with some brokers, and what they've seen in the last month is that listing prices have dropped, but selling prices have remained steady. So something to keep in mind for those in pricey markets who are kind of thinking this is a sign that the market is softening. It's maybe softening a little bit, but what you want to look at is not the listing price. Obviously, you want to look at what the houses are selling for, and they are still selling for consistently what they were 2 months ago. So interesting. I'm going to drop in a little anecdote about mortgage interest rates. So when I had my first mortgage, when I was 25, so that would have been 1996, 97. My rate it was a 3-year mortgage at 5.5%. And my father, who weathered double-digit mortgages throughout his adulthood, said, "Sandra, enjoy it. You're never going to pay this little again." And I've never paid that much ever. It's only ever gone down with slight, as you said, bumps. So really, really important to sort of keep that context in. There are a few naysayers who say that we're due for a big rise, but as you say, it's going to rise slowly because we have government controls. The central bank is controlling it to make sure that we don't have people getting into problems and seeing foreclosure like we did in the States a while back. So moving along, I just wanted to check in and see, we have any questions at this point?
Oh, we do. Ron has one here. He says, "We know that the stock market does not equal economy, but why are we seeing such a huge contradiction with the stock market going higher and higher while the economy is in the ditch? What's driving this discrepancy?"
That is a great question. I've written about that before because a lot of people do mistake that. I mean, our economy certainly is not doing well right now, but the market generally is more forward thinking. I mean, I think there's a couple things that maybe are a bit different than sort of normal, but number one, the market does seem to be a leading indicator. So people are feeling generally better about the long-term prospects of us coming out of the pandemic. So I think some of the reasons why the market has climbed is because people are optimistic that maybe a vaccine is coming, and we have seen stage 3 trials, and there's been some setbacks, although I think that's a good thing because that means that they're actually being taken seriously, but we are in at least phase 3 trials. The economy opening up, I think, had people excited, which was a big reason why the market rose. I think it's sort of maybe stagnated a bit in that now is a little bit more nervousness about where it could go. With cases rising, will they shut things down again? I think if things shut down again, then that could cause markets to fall again. But generally, I think there's some optimism that we will get out of this, and that's why it's happening. One of the other things that I think about and I wonder about, and this is just more maybe me wondering about this, is the people who are investing. We've seen the pandemic really affect low-income people a lot more than the high-income people. The jobs that have been lost are restaurant jobs, hotel jobs. I mean, hospitality is still down quite a bit from where it was at. The bankers and the executives and a lot of the middle class people in Canada who might have some money certainly have had jobs affected. but they are still a lot of them are still working, and so they're still investing in the market. And I think that so part of that is that maybe the people who are investing still have those jobs, are still putting money in the market, and that's why we've seen markets continue to rise versus people being super nervous and pulling all their money out and waiting on the sidelines. So I think that could be part of it as well. But I think, again, generally it's a leading indicator, and people are still optimistic, or the investors are still optimistic that something is around the corner. The danger is that could change at any moment. I mean, the market is the U.S. market, at least, is still quite highly valued from a price to earnings ratio. And that means that any volatility could cause people to panic. And so it doesn't mean, we're out of the woods on that volatility yet, but I think people expect the economy to pick up at some point in the future.
All right, great. So I wanted to talk about tech because it's been widely viewed that Canada is behind in the tech sector, except for Shopify.
Yeah. Well, this, I think, speaks to the larger issue that people have around home bias and diversification in the Canadian market. We've seen really one of the things that has driven the market to the last question as well, as tech companies have really done well. And we have seen in the US, Amazon, Apple, Zoom, a lot of these tech companies, are the big ones in the US, have done well and driven the market higher. It's been similar in Canada. Shopify's done incredibly well since the pandemic started, because it's an e-commerce platform and people want to use e-commerce. And so it's ripe for returns there. But that's driven our market higher, even though we're actually down a few percent on year to date, where the US market is up a bit. But Shopify's really driven us higher. And I think one of the issues with our market is that if only there were a second tech company. I mean, Shopify has driven this. If there was a second one, then maybe we'd have a little bit more of an information technology sector. There are some other ones and that have done well, but nothing of the scale of Shopify. And one thing I'm worried about is Shopify does seem to be a reasonably smart company in a great sector, but I hate to bring this up just in case any of this might scare anyone, but we had Nortel, we had BlackBerry. Those were big tech companies too. Nortel had its own kind of maybe separate issues at one point, but it was a big company. BlackBerry didn't keep up with the times, and that affected our market because they were pushing us higher. So it is a concern I think that Shopify is doing sort of driving things and is the only real tech company we have that's pushing the market forward. If something were to happen to that company, then I think our market could be in trouble. And I think that is the one thing that I don't even know exactly how to do this, but if we could somehow diversify our market more into different areas, and tech would be one, that we'd all be better off. And one of the issues is that Canadians have way too much money in Canadian stocks. So we have I think there was a 2017 survey, and that said that we had about 60% of our portfolios in Canadian stocks. And I think the math is, if you have 60% of your stocks in your portfolio in stocks and 40% in bonds, and 60% of that is in Canadian stocks, that's about 36% of your Canadian equity, your equity portion is in Canada. Now, the MSCI World only has 3% of Canadian stocks in its index, and that's sort of a guide where a lot of people say that we should go. If you look at some of the main ETFs that hold Canada, a lot of them are kind of between the 10 to 20% range. So even they're holding a lot. And they're still holding more US, which I think is good because it's a more diversified market, but it's something that Canadians need to watch out for. And it's one of the problems that we can never sort of really, I think, get ahead in a really good way, because our market is sort of cyclical because of that. So if the economy really revs up, we might do well because we are a cyclical market. Demand for commodities will increase. I did say before, oil prices will be, low for a while, but if it picks up, I mean, those things are good for Canada. Mining and the energy sector will pick up, and that could help our market. But we just can't sort of sustain those gains, and we sort of move like this a lot. And hopefully one day we can get more diversified. But it's not, a lot of tech companies are built in Canada, but get sold to the US companies. And so there's always been a comment on innovation in Canada that it's not enough. I think people are trying to figure that out. And hopefully they do, at least for investors, so we have more to invest in and maybe can buy into some of these great tech companies that Canada hopefully will, grow and sustain.
Well, right now we have a government, and the question for Canada as well, with an election coming up, is what will that look like come the end of the year? But we have a government that is focused on policies that are creating debt. Is that a risk in regard to the future of corporate Canada? Is there going to be room for innovation when we have a government that's focused on dealing with COVID? It seems, not necessarily, again, without getting too political, not as concerned with growing our corporate future.
I think there's a couple different angles there. I think I think the pandemic certainly set back corporate innovation because people are nervous, and companies are nervous. They're nervous about investing in R&D. I spoke to the CEO of Mars, which is an innovation hub in Toronto. This was a little while ago, right at the beginning of the pandemic, and he was very nervous about what would happen with the companies that they were supporting. And they have a whole bunch of startup companies that they support and help, and they were nervous that a lot of them could go bust. And these are small companies, but could become big ones, and are investing in or creating really interesting products. And they can't, and a lot of them just couldn't sort of sustain that. So I think there's issue there. Even with the big companies, I think there's a problem, problem with R&D, just because they are holding finances back. They're worried about investing and hiring people. Government, I think the government supports have helped keep some of these companies afloat. At least maybe, if they can survive the pandemic, they can bring some of this R&D back. They can start hiring people. So I think some of the, the wage subsidy, I think it's generally accepted that this stuff is helping in some way. How long does it go for is the big question. Our deficit is huge. We're racking up debts, but like Canadian consumers, the interest rates are low, so they can service this debt. I think there's issues when debt rises. Can they continue to service that? But there is a debate as to whether deficits and debt are real problems for major companies like Canada or the US. And it seems like I'm not worried about Canada defaulting. And I think that there will be perhaps a day of reckoning, maybe not a default, but where they're going to have to cut back programs and try and get this stuff under control. But, there's a lot of different opinions on this, but to me, providing those supports and keeping people working and keeping businesses active, I think could help in the long run. I guess the real question is, how long does this last? How much more support can they give? If this is another 2 or 3 years away, the conversation could be different. If it's a few months, if in a year people are, we're feeling better and everyone's going back to work in a regular way, then maybe we can look back on this and say, this is what saved our companies and allowed us to innovate faster than we would otherwise. But it's certainly all this is having an effect on Canadian innovation and just, the economy in general.
All right. Thanks, Brian. Do we have any other questions? I'm just keeping my eye on the clock. It looks like we've got a minute or two left before we need to wrap.
Yeah, we do here. Paul has, I guess to start with a comment. He says, MoneySense is an amazing publication website. I have been reading it for years. Thank you to the whole team. He also has a question. Given the Canadian market as a whole has significantly underperformed the US, do you think now is a good time to increase Canadian exposure and possibly lower US exposure?
Good question. Well, thank you for the kind MoneySense words. I've been working for MoneySense since 2008. So, and I know Sandra was there, has had a couple different stints there. And so we hold money dear to MoneySense, dear to our hearts. So thank you. I guess the question is sort of back to this diversification angle. You could sell US, it's kind of overheated a bit, but I still think it's probably kind of the best opportunity for growth. The Canadian market, with the financial sector and the energy sector making up such a large portion of our market, it feels like we may not be able to kind of get back to where things were for a while. I mean, the financial sector could struggle for a while. We're only starting to see, the mortgages come back online. A lot of people suspended those. Will they be able to pay that? If there's more job losses, how will that affect the real estate market? Rates are low. The energy sector is struggling. So I think the Canadian market will still underperform the US market for a while. But at the same time, if you are not overweight too much in Canadians, if you maybe you did sell off some of that stock, it's certainly below where it was. The market, the forward PE of the S&P TSX is about 16 to 17 times earnings right now. That's down from about 20 or 22 where it was kind of over the last couple of years. So it is cheaper. I wouldn't go crazy and go whole hog into Canadian equities for all the reasons I talked about, even if it is cheaper. But you could add some allocation if you think you're below. I was talking to Franklin Templeton, portfolio manager recently, and he's neutral. He actually did increase it a bit from where they were underweight. He's neutral. He's not overweight. So that might be kind of a good way to go. But I wouldn't dump too much U.S. stock. I still think, just based on the companies they have there and the diversification profile, feels like it's a bit more of a core part of a portfolio than perhaps even kind of Canadian stocks.
Can I put you on the spot for one last thing? What about international exposure? Is that something that we should still just sort of dip our toe in? How seriously should we look at that in our portfolio?
Yeah, I mean, international, you got to have it. I mean, I think you have to have a diversified portfolio, and that includes international. We often focus on North America. A lot of great stuff internationally as well. I mean, emerging markets tends to rise and fall when people are feeling nervous. It goes down. So it's still, despite it has matured over the years, it's still a risk asset where people sell it when they're nervous and buy it when they're not. But I still think, there's a lot of opportunities there. China is still a massively growing country, despite maybe some of its faults politically that, been in the news and the trade wars that are happening in the US. It's still growing like crazy. Just the amount of people there. So I think you need a good portfolio for all of it. And to me, I mean, MoneySense preaches ETFs, and we have some stuff for stock pickers on our website, but I'm an ETF investor. I don't really pick stocks. I just stick with the ETFs. And the couch potato portfolio is our, famous thing that we always talk about. And I still think that's a good way to go. I mean, market returns that are diversified across different sectors and geographies, and hold that till retirement, and that'll get you somewhere. And then if you have other money to play with, sure, go for the stock picks. But to me, that makes up the core portfolio, and you can find out all about that on MoneySense.
And to me, what's compelling about ETFs, again, it's a reinforcing thing, is pro money managers did not satisfactorily beat the market in the last few months, when they had an opportunity to really kind of flex their muscles and show what hands-on money management could do. They did not significantly beat the market, and some of them did not beat ETFs. So I think it's not just safe, it's smart.
Right. You don't know. I mean, you think that nobody called this pandemic. I mean, you think if you were to invest in a fund, perhaps, I mean, maybe some people did, I'm sure there were, but you would think that maybe the people watching the market maybe would have known about something like this, but they didn't. I mean, it's hard to predict. And so that just kind of proves again that stick to ETFs, and that could get you through your years towards retirement. And then you can supplement that with maybe your favorite fund manager who is doing well, stocks or other different investments.
All right. We should probably wrap it there. Thanks so much, Brian. You had a lot of weight on your shoulders with this segment, so thank you so much for being up for it. Anything else that are on people's minds before we wrap?
Yeah. Do you have any intermediate prospects for the Canadian dollar?
Good question. Currency. I don't focus a ton on currencies. So maybe if there's a Forex trader later, you should talk to them about that. But I think that what I can say about that, just based on sort of, I think the economy, is that we don't want the Canadian dollar to get too hot, or that could really ruin the manufacturing sector, and which would be difficult in a time like this. Just our exports, we need those. So I think the Bank of Canada will try and keep it to a level where it's at now. I think if the U.S. improves, the U.S. dollar could get more attractive. I think if people get spooked, then the Canadian dollar would be maybe a bit more of a safe haven asset, which is what we've seen in the past when people are a little bit down on the U.S. The Canadian dollar seems to do well. But to me, it seems like, just kind of based on what's happening, I can't see there be too much movement in either direction right now. If anything, maybe it could fall compared to the US dollar a bit, but I think to me, it'll, I think we're kind of in a holding pattern here for a while till we see what's going to happen with the pandemic. And again, just based on the impact it could have on our economy if it gets too high. But if there's a Forex person, I'd ask them that question as well and see what they say.
Thanks, and we have time for one more question here, if you don't mind. What Canadian bank do you think is a good buy right now?
So I haven't looked super closely at all of the different banks. I mean, I still, based on kind of the stuff that I've done in the past, I still like TD Bank is still an interesting bank to me, in part because of their US presence. So we've had, like, Scotiabank's gone out to the Latin America, has been not as successful there. CIBC is a lot more focused on the Canadian investor. And so that's, it could be good or bad. I mean, that's again, sort of on the diversification part of this. They're not very diversified in their base. So if Canadians do run into more financial problems, then that could hurt CIBC. TD is a bit more diversified. They have the US consumer. US jobs are down. There's a lot of impact there, but if their economy is still open, despite the rising cases, that could be a benefit for TD. BMO has a big capital markets division, so they do a lot of work in Europe and other parts of the world. That activity is still happening. Possibly, I think it maybe slowed down a bit kind of when people are uncertain, but that's still happening. TD pays a good dividend. So I would take a deeper look at maybe TD or some of the other banks that have a bit more of an international diversified presence. Those seem to be the ones that have done well and that fund managers have recommended to me in the past. And I think that still holds true today.
Yeah. Just looking back at some of our coverage of bank earnings in the last quarter, I mean, a lot of them did really well. Royal Bank increased revenues by 12% year over year, which is not to say you should base your decision on one quarter, but that was significantly above the other big banks. But I think, Brian, always going back to the fundamentals, which is very much in the money sense way, looking at, what's had a solid history over the last several years, not just what's looked good in the last few quarters.
For sure. I mean, we'll get through this. It's going to be tough, but we'll get through this and things will get back to hopefully some normalcy. And I mean, in the meantime, it's great that the markets are up. They could fall again. So people's portfolios hopefully haven't been impacted too much. But, when you look back at 1918 and the Spanish flu, eventually they got over that, and that lasted a couple years, and it's tough now, but we'll get through it. And so I think that long-term perspective is still something to keep in mind, even though it does feel like everything is very short-term and uncertain now. But, we'll still be around for a while, I think.
All right. Well, thank you both for joining us today. It was a great presentation. We really appreciate it.
Thanks so much.
Have a great day, everyone.